Welcome back to FT Markets. These are crucial days, crucial hours for Greece. What's going to happen to its banking system? Will it be able to make its payments to the International Monetary Fund and the European Central Bank? Would it even be thrown out of the Eurozone? With me to discuss how financial markets may react in the days to come is David Riley, who's Chief Strategist at Bluebay Asset Management. David, welcome to the Financial Times. The striking thing about market reactions so far to Greece is it's been relatively calm. We could look at things like the bond yields on countries such as Italy and Spain. Stock markets up slightly today even. But we've got a chart showing a little bit, something a little different. We're looking at the credit default swaps. This is the cost of insuring against defaults on European banks and Greek 10-year bond yields. What's the story in your view?
Well, I think what it highlights is that, as you said, that we haven't seen actually much contagion compared to previous episodes when Greece has been front and centre.
2012,
as we saw,
those terrible days.
Precisely. And part of what we had going on during the crisis then was that we had this sovereign bank nexus where weak sovereigns would infect banks, which in turn would contaminate or be a source of contagion to their home sovereigns. And so we had that as a key source of cross-border contagion. And we haven't seen that, and I think we haven't seen that for good fundamental reasons.
There's a pick up in CDS swap rates, insurance rates, but nothing very dramatic.
Absolutely, and I think that's because European banks are certainly better capitalised than they were, and their exposure to Greece is much less. But all of that being said, I think it's also reflecting the fact that investors are still underestimating and not positioned for the worst case scenario.
I know you believe strongly in that, but we'll come back to that. But just there are reasons for thinking that if Greece did exit, things might not be so bad. If we look at our second chart, slightly complicated. What we've done here is, well, firstly, the red line. This is a little indicator the European Central Bank uses to measure the probability of two banks defaulting at the same time. During 2012, shot up, now back low again. So the systemic risk is quite low, according to this indicator. And then the other lines, the green and the blue, show non-Greek banks' exposure to Greece, which back in 2012 was significantly higher. This provides some reassurance.
Well, absolutely. I mean, you can see through the green bar, which is European banks' exposure to Greece, that in 2009, before the crisis intensified, they had more than 130 billion euros of exposure. For international banks as a whole, it's more like 225 billion. By the end of 2014, for European banks, that was down to around about 10 to 14 billion euros. I think we can be pretty confident that that number has shrunken further.
But you believe actually markets are getting it wrong to an extent. They're underestimating the consequences of Grexit, Greek exit. Why is that?
Well, I think that one of the messages that we got from European policymakers during the height of the last Eurozone crisis and the Greek crisis was that people like me,
hedge funds managers,
asset managers, and also when I was previously involved in working at a rating agency, was you don't understand the political commitment, that this is a political project to the irreversibility of the euro. You've got it wrong, you don't understand. And right now, I think we're in a situation where the market is actually, I think, underestimating both the risk of a Grexit, and they're certainly not positioned for a Greek exit from the Eurozone, but fundamentally, any exit from by Greece would fundamentally challenge that notion. Because what it would say is markets can't force a break of the euro, but you were right. Politics can. It's about political will.
And the politicians saved the euro in 2012, but if they don't do it this time, then that's a credibility problem for the whole Eurozone, is what you're saying.
Absolutely. At the moment, I think investors are taking a lot of comfort from something which they felt they didn't have during the last episode of the crisis and Greek crisis, which was a European Central Bank willing to step in and effectively act as a lender of last resort.
That leads me on to, it has to be my last question, unfortunately, but if we do go to Grexit, then how big a reaction do you think there might be?
Well, I think initially it's going to be pretty severe. Investors are still significantly overweight risk assets, are overweight the periphery and European stocks. If we get a worst case scenario in Greece, we could easily see spreads go out 50, 100 and 150 basis points.
Quite a lot more than they have already, obviously,
But I think the key aspect there is that, does that then become a kind of self-fulfilling crisis where it threatens the solvency of some of these other countries and in the periphery, as we saw during 2010, 2012, before the, whatever it takes speech?
Yeah, so we're testing the European Central Bank's crisis management capabilities very much.
And I think they're ready to intervene and to stop that. So don't think that the contagion is going to be a sort of domino effect. But over the medium term, it's going to make investors much more sensitive to political risk within Europe. Next time it looks like we're going to get an anti-Euro, anti-establishment party coming to power, whether it be in Spain or Italy or France, investors are going to be very, very nervous.
David, we'll have to stop there. Thank you very much. So a warning there about the potential implications for market worries about European political risk if we get a deterioration in the Greek situation.